After today's monetary policy, where Reserve Bank of India highlighted its risk on growth and inflation both, where they have indicated that their expectation on growth continues to drive lower, at the same time highlighting the risk of inflation coming higher than their own projection through the year. On the inflation side, what they have indicated is their concerns on inflation arising out of higher energy prices, like say higher crude oil prices, and the currency depreciation, which we have seen where INR has depreciated against dollar about say 15 to 17% through the year, or from in last say probably say 4 months time. So these two combined are forcing RBI to have a relook at the inflation projection, which they find that inflation going forward will be higher than their anticipated levels, which they had given in the annual monetary policy on 3rd of May 2013. On the growth side, RBI continues to acknowledge that growth will continue to remain below potential growth, and they have highlighted the fact that even in the rural areas, the growth has moved down, and as can be seen by the reduction in the durable goods purchase and sales. So going forward, RBI has indicated that growth will continue to moderate, and we expect that growth will be averaging about 4% through the current financial year, which is 2013-14. And our own assumption is inflation on WPI index will average about 5.5 to 6% through the year, which was against our earlier expectation of roughly say 4.5 to 5% through the year. RBI has in today's monetary policy has taken steps whereby they have reduced the MSF rate, which is marginal standing facility rates, which was at 10.25%, by 75 basis points to 9.5%, and they have increased the repo rate from 7.25% to 7.5%. What is of bigger importance today is the MSF rate, where practically in the tight liquidity conditions, as we are seeing in today's scenario, your RBI operating rate is MSF rate, and which has been reduced by 75 basis points. Whereas the medium term guidance from the Reserve Bank of India, because of inflation expectations moving relatively higher against their own earlier projections, they have increased the repo rate by 25 basis points to 7.50%. Market has reacted adversely to this, where we have seen 10-year benchmark government bond yield has gone up from 8.2% from yesterday's closing levels to 8.50%. Why this has happened is the market was not expecting any rate hike in the repo rate, whereas market was divided on the MSF rate cuts between 50 basis points to 100 basis points. So RBI cutting MSF rate by 75 basis point is perfectly in line with market expectations, but the big negative surprise market perceives is the increase in the repo rate from 7.25% to 7.50%. We see it as long as RBI is reducing its operating rate by 75 basis points, which is very important thing to look at. And going forward, we expect another 75 to 100 basis points cut in MSF rate from 9.5% to probably say it coming down to roughly around say 8.5 to 8.75% levels. So looking at that scenario, we strongly believe that investment horizon, if the investment is done in 2 to 5 year maturity bucket, which is the short and medium term interest rate bucket, is going to be beneficial for investors. Apart from this, we expect the 10-year bond yield to trade in the range of 8.10 to 8.60%. Going forward, we will be keenly watching the movement on the INR, the currency of Indian rupee, how it behaves, and that will also make RBI move the frequency and the velocity of further rate cuts on MSF and repo rate alterations are concerned.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.